Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's very important webinar, that is the webinar on standards on assurance engagements. As we all are aware that we are having three SAEs, so today we are going to cover SAE 3400 and SAE 3420. So in order to tackle these two very important standards on engagement, we are having with us CA Pareen Shahji. So on behalf of AASB of ICI, I extend my warm welcome to you, sir, on this webinar organized by AASB of ICI. Welcome to you, sir. Namaste. I also extend my warm welcome to all the participants of today's webinar. So before we formally start our today's webinar, that is very important. It is my proud privilege to share with all of you the brief profile of CA, Shri Pareen Shahji. Shri Pareen Shahji is a practicing chartered accountant and partner of the firm CNK and Associates LLP CNK Chartered Accountants and heads audit and assurance services at CNK Vadodara. He is having experience of more than 15 years in statutory audit of various listed and unlisted companies and other entities. He has cleared certificate course on Ind AS and international taxation. He has also have handled assignments relating to audit of various large listed and non-listed companies. He has addressed chartered accountants and other professionals at various forums on accounting and auditing topics. He has provided consultancy and trainings relating to the convergence and implementation of Ind AS, IFRS, and on other company law matters to the corporates. He is assisting Baroda branch of ICAI for the providing comments on the exposure draft on various Ind AS accounting and auditing standards, and he is external examiner for graduation course at the MS University of Vadodara. Still, the list is very vast. So, without wasting much more time, I request our honorable guest speaker for today's webinar, Shri Pareen Shahji, to please start his deliberation. Over to you, Pareen Shahji, please.
Okay. Good afternoon. I would like to first of all thank ASB for giving this opportunity to share my view on a topic. Generally, we have a feeling that auditing standards and SRE are more or less a theoretical part. But if we see both the SRE, which I am going to cover today, have very much implication in our day-to-day practice also. So I would like to start, I will share the screen and like to start my presentation. So the SRE, the first thing which will be covered, that is SAE, Standard on Auditing and Assurance Engagement, SAE, SAE 3400. So it is applicable to the assignments or to the when as an auditor or as a practitioner, we examine the prospective financial information. Now, if you see what is the prospective financial information, in day-to-day life, we have been approached by our client that we need to give some project report to the bankers. Now we prepare the project report, we give it to the bankers. Afterwards, the bankers come to the client and says that it should be CA certified. Now we are always in a dilemma that whether as a CA, I can certify the projected financial state or prospective financial information, a project report, whether it can be signed by me, whether if I sign, whether I will be guilty or not. So what does our act says? So the guidance as provided as per the provisions of clause 3 of part 1 of second schedule of Chartered Accountant Act, it says that the chartered accountant in practice shall be deemed to be guilty of professional misconduct if he permits his name or the name of his firm to be used in connection with an estimate or earning contingent upon the future transactions in a manner which lead to belief that he vouches for the accuracy of the forecast. So see, our Chartered Accountant Act says that if we vouch for the accuracy of forecast and we give a certificate, then it will be deemed to be guilty of misconduct. However, they have said that if a chartered accountant in practice, he is giving a certificate and in his report, he's clearly mentioning the source of information on the basis of which he is giving a certificate on prospective financial information, the basis of forecast, the major assumption made, then in that case, he will not be guilty of misconduct and those project reports or certification of debt prospective financial information will be covered under SAE 3400. So sometimes I come across the questions that whether SAE are part of auditing standards. Very much they are the part of the auditing standard per se. Because while following the SAE, they provide a specific guidance for a specific issue. But while discharging our duty as an auditor or as in for providing assurance engagement, we need to comply with the other auditing standards also. So the purpose of this SAE is to establish standard and provide guidance on engagement to examine and report on the prospective financial information, including examination procedure for the base estimate and hypothetical assumption. So see, the financials which we have already certified that are known as historical financial statement, and the prospective financial information will cover the things that has been prepared, forecasted or projected based on some estimates or assumption. Now the estimates can be the base estimate or it can be a hypothetical assumption. In my next slide, we will be going through the what is the meaning of base estimate assumptions and the hypothetical assumptions. Now this SAE 3400 is not applicable to examination of prospective financial information expressed in general or narrative terms. So what does it mean? We all know that in the annual report, the company might have given the various figures which are based on the forecast. So we will be achieving this, we will be achieving this. So this SAE will not be applicable to those information because in any case, it has not been vouched by us. Now the principles of standards on auditing should be used as much as possible by the auditor in applying this SAE. So already discussed that while following this SAE 3400, the auditor or the examiner should compulsory follow the guidance which are provided under the other auditing standards. And at the last, who is responsible for the preparation of this prospective financial information? That is management. So the management is responsible for the preparation of this prospective financial information. And as an auditor, what is required? That as an auditor, we validate and report the same. So what we have to report? We have to report that the assumptions or the estimates which have been considered by the management while preparing this prospective financial statement are in line and are not on a hypothetical basis. So this is a certification which we need to give to the outsider. So when in an engagement to examine prospective financial information, the auditor should obtain sufficient appropriate evidence as to whether. So while discharging our duty as an auditor, we should obtain the sufficient appropriate evidence so as to justify that the management-based estimate assumption on which the prospective financial information is based are not unreasonable. So whatever based assumptions are given to us by the management, we have to verify it that they are not unreasonable. And in the case of hypothetical assumption, such assumptions are consistent with the purpose of the information. Further, we should take evidence that the prospective financial information is properly prepared on the basis of assumption. So assumption notes may we have written something else while in the preparing the prospective financial information, we are taking the different figures. It should not happen. Whatever we have write in our assumptions, for example, if we say in our assumption that it is estimated that the sales will increase by say 8% for next 3 years, and it is in line with the forecast which has been provided to us by the management and the working provided to us by the management. That is a information or assumption. Now, when preparing the prospective financial information, we take 15% sales rise every year, then there will be a dissimilarity between the information and between the assumptions. So it should be checked that the prospective information is properly prepared on the basis of assumption. Then it is properly presented and all material assumptions are adequately disclosed, including a clear indication whether as to they are base estimate assumption or hypothetical assumption. So it is very important, friends. Generally, sometimes we certify the project reports, but we never write the assumptions. And suppose we have written the assumption, we never demarcate between the, or we clearly indicate that these are the best estimate assumption and these are the hypothetical assumption. So while disclosing in the notes, the assumption has to be clearly demarcated between the best estimate assumptions and the hypothetical assumptions. And at the end, the prospective financial information is prepared on a consistent basis with the historical financial statement using appropriate accounting principle. So whatever years or period which is covered under the prospective financial information, the period should be covering appropriate accounting principle and same accounting policies. It should not happen that in 1 year we are following a different accounting policy, and while preparing the projected or prospective financial information, we are having a different accounting policy or principles. So while preparing the prospective information, the appropriate accounting principles and the policies should be consistently followed by the management. So now there are certain definitions which are of importance. So what are the prospective financial information? So prospective information means a financial information based on assumptions about the event that may occur in the future or possible action by an entity. So we all know that prospective means based on some assumption, management will estimate its profit, its sales, and other things. And based on that, certain event will occur in future and the possible action which will be taken by the management or by the entity. However, we know that it is highly subjective in nature and its preparation requires the exercise of considerable judgment. It can be in a form of forecast, a projection, or a combination of both. So if we see prospective financial information, two terms are of very importance: forecast and a projection. So what is the difference between forecast and a projection? So now in next definition of a forecast. So forecast means a prospective financial information prepared on the basis of assumption as to future event which management expect to take place and the action management expect to take as of the date of information is prepared. Forecasts are more reliable than the projections. Forecasts are made based on the various documents which are or information which are already available to the management. And based on that, they make an assumption that certain event will occur in the future and what will be the steps taken by the management as against that action. And it is also known as a best estimate assumption. So forecast is mainly done based on some working, some documentation which are available by the management. Proper working is there, and therefore it is considered as a best estimate assumptions. Now projections. Projections means prospective financial information prepared on the basis of hypothetical assumption about future event and management action which are not necessarily expected to take place, such as when some entities are in a startup phase or are considering a major change in the nature of operations. So if we see, if some companies which are in startup, they don't have any historical yardsticks. Neither they have the data on their hand to prove that, yes, we will be achieving this much of the turnover in next 5 years or this much of the profit. So whatever major workings will be prepared for the purpose of prospective financial information, that will be based on the hypothetical assumption. Obviously, there will be some working, but that working cannot be considered as a best estimate assumption. So to give you an example, if the management is preparing prospective financial information based on the sales order, which are confirmed sales order for next 1 year, and based on that, if the information is prepared, it will be considered as a best estimate assumptions. However, there are not confirmed orders, but the information is prepared based on the assumption that the market will reciprocate and our turnover will increase 10% as per the future, as per the past trend. It is a hypothetical assumption. Further, a projection can be a mixture of best estimate and a hypothetical assumption. So 3 definitions, very important. Prospective financial information, what are they? Forecast. Forecast are the assumptions which are made based on the best estimates which are available with the or documentation which are available with the management, and projections. So these 3 definitions are of utmost importance. Please keep it in mind. Now, responsibility. So, who is responsible, or what are the responsibilities of the management? So the management is responsible for the preparation and presentation of the prospective financial information. They are also responsible for the identification and disclosure of the source of information and the basis of forecast and the underlying assumption. So firstly, management responsibility are already specified in the standards. That the management is there, firstly, they have to take the onus of preparing the prospective financial information. They need to give us a disclosure that from which source they have taken the information while preparing the prospective financial information, and what are the bases of forecast and the assumptions taken by the management. So as an auditor, the auditor's assurance regarding prospective financial information. See, we all know, we have seen in my earlier slide that the prospective financial information or the certification which we will give will be based on the future events, and they will be highly speculative in nature. So in that case, we cannot give reasonable assurance. We cannot give true and fair or true and correct. So as an auditor, what type of assurance is needed or to be given by us? So the standard says that the auditor sometimes may be asked to examine and report on the prospective financial information to enhance its creditability. So suppose you are giving a project report to the bankers, they will say that you have prepared the project report, but whether you will be achieving your targets or not. So to increase its credibility, kindly get it signed from your auditor or from some another chartered accountant. So in that case, our role will come, how we will issue an examination report, what type of assurance as an auditor we will do. So in this case, the prospective financial information relates to events and action that have not yet occurred and might not occur. So in that case, the evidences related to same are also generally future-oriented and speculative in nature. So in this case, the auditor is not in a position to express opinion as to whether the results shown in PA5 will be achieved. So we cannot vouch for the accuracy. We cannot say, no, yes, these are the assumptions which are given by the management. And based on this assumption, this will occur, and we vouch for the accuracy of the forecast. And this itna to turnover hone hi wala hai. We cannot certify in that manner. So when we give a report for certifying the prospective financial information, we should be giving, as an auditor, we should be giving the reasonableness of the management assumption, and the auditor provides only a moderate level of assurance. We do not provide a reasonable assurance or a true and fair or true and correct. We provide only a moderate level of assurance while issuing the examination report under this SAE. So now we have gone through the things that what should be done, what should be certified, what things the auditor needs to keep in mind. The auditor should consider the assumptions. The auditor should consider the best estimate, whether the assumptions taken are the hypothetical assumptions or the best estimate assumptions. Now, what care the auditor should take while accepting the engagement? Once a client comes to you and they say that please certify or please give us the examination report on the prospective financial information. So as an auditor, how you will accept or what care should be taken while accepting the such kind of assignment. So before acceptance, the auditor should consider the intended use of information. So the auditor should inquire where the examination report needs to be given. So whether it is needed to be given to the bankers by the management, whether they need to give it to some investors, whether it might happen that sometimes we certify the prospective financial information in the prospectus itself. So whether it is needed to be given to some regulatory authorities. So what is its intended use is of utmost importance. So it should be inquired before accepting the engagement. What are the nature of assumptions considered by the management? How much period will be covered? So period covered will depend on various factors. We will get through in our next slides. So period cover has to be mentioned in the engagement letter, and whether the information will be used for general purpose or for the limited distribution. So these are the points which should be covered in our engagement letter before accepting any such assignment. And if the auditor should not accept or should withdraw from an engagement when the assumptions are clearly unrealistic, or when the auditor believes that the prospective financial information will be inappropriate for its intended use. So sometimes clients come to us, they say that you prepare or you give an examination report based on that sales will increase 15% year on year. Then only my CC limit will be justified. So we cannot give a report in such a manner. We need to follow the conditions of this standard or this SAE. We need to take the best estimate assumptions, the documentation from the client to support its assumption. We cannot straightaway certify that yes, whatever you are saying, we accept it and we are signing the project report. No, you cannot do that. So in such case, as an auditor, we should withdraw or we should not accept such assignments where the assumptions are clearly unrealistic, or whether the auditor believes that it is inappropriate for its intended use. Now, when we give the engagement letter, kindly follow SA 210, that is the term of audit engagement. And it is necessary that the auditor and client should agree on the terms of engagement. So once the engagement letter dictates the terms as an auditor and the terms of the client, we should be mutually agreed on the engagement or the engagement points which are later in which are mentioned in the engagement letter. Now, once the engagement letter has been accepted, what are the auditor consideration? How will the auditor proceed further to give an examination report? What are the points which the auditors should consider while giving the examination report? So first is the knowledge of the business to evaluate all significant assumptions. See, if you do not have the knowledge of that business, how you will be able to justify the assumption? How you will be able to justify that the assumptions given by the management are true or not? So as an auditor, we should collect or we should get the knowledge of the business to evaluate all the significant assumptions. And second thing to consider is the period covered in the prospective financial information. So period covered, I will take first it. Period covered will depend on various factors such as the nature of loan, the nature of industry in which the client is operating. If you take an example that you have taken a term loan from bank and term loan is for say 7 years, then the period covered should be at least 7 years. And one thing as an auditor, you should be clearly understanding as the period increases, the assumptions or the validity of the assumptions or strength of the assumptions decreases. Because as a management would give you the working or the supportive for next 1 year. They will not give you for the full length of periods of 7 years that we have sales order on hand. So while certifying the examination report, kindly go through what is the period required to be covered under the examination report, and then only you accept the assignment. Knowledge of the business. So apart from knowledge of the business, other factors to be considered by the auditor while certifying the examination report is the first is the internal control over system used to prepare prospective financial information. So you should go through the internal control, how the data are collected by the management, what are their MIS monthly, whether there is monthly MIS, quarterly MIS, how the data are collected, whether the proper provisioning is done on a quarterly basis or monthly basis. And on that basis, whether the information which will be given to us by the management will be reliable or not. So internal control over the system has to be considered. Then the experience and expertise of the team who is preparing the prospective financial information. So you need to consider as an auditor that the person who is preparing this prospective financial information has proper experience and expertise in it. Otherwise, it will happen that they will give you a raw data and they will say that this is the thing and you certify the same. So it should be considered while accepting the assignment or while moving forward for the assignment. Now, nature of documentation prepared by the entity to support the management assumption. Then extent of statistical, mathematical and computer assisted technique which are used by the management. So suppose if the client is having say multi-locational client, how they are collecting the data from the multi-location so as there are no provisioning left out or all the data are captured, whether there is any mathematical error, all things need to be considered while going through or while issuing the examination report. What are the method developed by the management while applying the assumptions? And we should also see that the accuracy of prospective financial information prepared in the prior period. So earlier, if the management has given some project report or financial information to its investors or lenders, whether they have been able to achieve those targets or not. That can be also one of the points which can be considered by the auditor. And if there are some significant variation that why they have not achieved the earlier assumptions or earlier information which were given, a reason should be asked for from the management. So these are the factors which should be considered by the auditor. Then the auditor should also consider the extent to which the reliance can be placed on the entity's historical financial information. See, in historical financial information, the auditor is required to have the knowledge to assess whether the prospective financial information has been prepared on the consistent basis. So we have already discussed that in past, if the company is having a historical yardstick of say profit of say 6%, and in prospective financial information, they are saying that the profitability is 10%. Then the questions will be raised by the auditor that how the 6%, how the management will be able to achieve this 10% in respect of that 6%. And various assumption or best estimate assumption supporting those figures should be taken from the management. So historical yardstick is of very much important. Further, historical yardstick is of importance because whatever accounting policies which were followed in past has to be followed in future. And if the auditor, if the historical information which was audited and reviewed and whether the accounting principle were used in its preparation. And if the audit or review report on the prior period historical financial information was other than a clean report, or if the entity is a startup, the auditor will consider the relevant fact and the effect on the examination of the prospective financial information. So to sum up, why historical financial information or statement are important? Because firstly, to check whether the assumptions are in line with the past historical yardsticks. Second, to check whether the consistent accounting policies are followed by the management while preparing the prospective financial information. Third thing, to check whether the prior period historical financial information were audited or not. And if they are not audited, then as an auditor of the prospective financial information, we need to carry on that process so as to make them reliable. And if in past the review report or the audit report was not a clean report, then the auditor should consider the possible impact of the same on the prospective financial information. So these are the 4 points for which the historical financial information will be of very much importance. Nature, timing, and extent of examination procedures. So what should be the nature, what should be the time and the extent the auditor should do for the examination procedure? So we have already seen that the auditor should obtain the knowledge of its previous engagement, knowledge of the business, the sources of information and assumption considered by the management. So the source can be internal or external. Internal source can be the MIS which are prepared by the company. The various documents, various agreements which are entered by the company, board reports, audit committee reports, that can be the sources of the internal assumption. So if the management says that we are in future in prospective financial information, you take that we are going to do a capex of say 100 crores. But whether their board report or the audit committee reports justify those assumptions, because in the board report they have to write, they have to take a approval if they are going for the major expansion. So these are the sources which the auditor should go through. These are the internal sources. Now for the external sources are the government policies, economic forecast, overall industry performance. So these are the assumptions which can be coming from the external sources. So as an auditor, we should consider the information and assumptions which are based on the internal as well as the external sources. Then what are the significant implications of the assumptions have been taken into consideration? So suppose if the client says that our sales will increase by say 50% in next year. So that will be the point that how? वैसे तो sales 50% एकदम से तो increase हो नहीं जाएगा. You have already, we can vouch that they have already exceeded their total capacity. Then in that case, as an auditor, we should inquire that whether the company will be going for the another capex expansion or not. And while preparing the project report, the possible implication of the increase in sales as well as the capex expansion should be taken into consideration. So once sales will increase, the depreciation, the interest component on the capital expansion should be considered while preparing the prospective financial information. Then the auditor should focus more on area that are particularly sensitive to variation. So while preparing the prospective financial information or while examining the same, you should be going through which are the critical area or sensitive area to that in the particular industry. If suppose labor, that is a sensitive area. Suppose labor is say 40% of the total cost, then it is a sensitive area. And we should write in our prospective information that if there will be a 5% change in this, what will be the implication on our profitability or on our financial information. And it should be shown in the prospective financial information. The auditor should also see the stability of entity's business. So at least we should know the business and we should at least see that the business is stable. It will not be outdated. It is not going to be outdated within say 4 or 5 years for which we are preparing the examination, prospective financial information. And what are the factors by which there will be a likelihood of material misstatement in the prospective financial. So while carrying on the examination procedure, all those points need to be considered by the auditor. And if the auditor is satisfied on all those points, on all those assumptions which are given by the management, then only the auditor should issue a clean report. Then again, please take written representation from management regarding what are the use of prospective financial information, the completeness of the significant management assumption, management acceptance of its responsibility for the prospective financial information, and management responsible for identification of uncontrollable factors. Suppose there are many outstanding litigation in the company, or there may be capital commitments which are not considered by the management while preparing the prospective financial information. So as an auditor, we should ask them what are the outstanding litigation, and the management is responsible for giving the same to us. And as an auditor, we should vouch whether it will be having impact on the prospective financial information or not. But generally, practically, if we see when we prepare a prospective financial information or a project report, we never write this outstanding litigation, its impact on the prospective financial information, the capital commitments, and any other material factors. We do not write in our while we certifying the project report. And at the end, what should be presented and what are the disclosures to be made in the examination report. So the presentation of prospective financial information is informative. The accounting policies should be clearly disclosed in the note. So whatever accounting policies are followed while preparing the prospective financial information, it should be mentioned by way of notes. The assumption should be adequately disclosed in the note, and it should be clear whether it represents the best estimate assumption or a hypothetical assumption. the date on which the prospective financial information was prepared is to be disclosed. Now see, the date is of very important, because any assumptions which will change after this date, because assumptions are there, it will be changing here and there. So any assumptions which change after this date, the auditor is not responsible for the same. So the date is of very much important. In case of assumption subject to high degree of uncertainty, the uncertainty and the resulting sensitivity is to be disclosed. So we have already discussed that if there are certain factors in by which the profitability may increase by 10-20%, there is a high degree of uncertainty in those assumptions. And in this assumption, we need to clearly write that we have taken this as, suppose while preparing a project report, we say that the raw material prices would be same for say next 2 years. But it is a high degree of uncertainty because it may rise. So in our sensitivity report, we need to write that suppose the raw material prices increase by 5%, then this will be the impact on the profitability. And if there is change in any accounting policy of the entity, what are its effect and how the auditor has dealt with the same. So this all things needs to be written in our examination report by way of note. So now as an auditor, what documentation should be done by us? So it's the source of information should be properly documented. That what can be the source of information? It can be external source or it can be internal source. It can be the historical financial statement. It can be a historical financial information which has been shared by the management to us, but it has to be properly documented from mentioning the source of information. Then the basis of forecast and the assumption made in arriving the forecast. So what are the basis and what are the assumption while making the forecast has been done? So if we say that we have taken the trade receivable at say 2 months of the sales. Now it should be that the assumption is made is based on the proper documentation. If suppose in your agreement, you are giving a credit of say 90 days to your debtors, to your trade pay receivable, and while preparing a project report or a prospective financial information, you are taking 2 months later, then it do not justify. It do not justify. If you are giving a credit of, taking a credit of say only 1 month from your trade payables, and while forecasting or preparing a projected financial information, you are taking a credit period of say 1.5 months or 3 months. So it is not justifying the assumptions which are taken by the company while preparing prospective financial information. So all things need to be checked before preparing the same. Now, what are the hypothetical assumptions and what are the supporting evidence taken by the management and given to us should be documented. Now, management representation regarding the intended use and distribution of the information should be documented. Completeness of material assumption. So it cannot be abruptly that we are taking this assumption. There should be some basis. If the company say that we have profitability of say 10%, 12%, then as an auditor, we should vouch that whether the historical statement reflect those figures. If no, what are the things by which the profitability will increase? Whether there is some change in government policy, whether there is a change in accounting policy in the government policy or in the technology which the company is going to use by which the profitability will increase. So all questioning has to be done to the management and proper completed material assumptions are needed to be documented. Please document the MRL, that is the management acceptance of its responsibility for the information. In such a case, MRL is of very much importance because if something goes wrong in future, MRL and the engagement letter will be the basic documentation which will be available to you to defend your case. Please document the audit plan, how you have gone through the whole thing, how you have carried on the examination procedure, what are the timing, what are the extent you have performed the procedure. Fully documentation has to be done. And if as an auditor, you have expressed a modified opinion, or if you have withdrawn from the engagement, the reason for forming the basis of such decision has to be documented. So it might happen that you do not agree with the management assumptions, and you give a modified opinion, or in a worst case you might withdraw from the engagement. So kindly document all the reasons, all the assumptions which were not fulfilled by the management, and therefore as an auditor you have resigned or you have given a modified opinion. So it has to be properly documented. So this is the report, how the report should be there. Report on examination of prospective financial information. So firstly, there should be a title. A title says that a title should be report on examination of prospective financial information. Then addressee, to whom it is addressed. Whether it is directly addressed to the bankers, it is directly addressed to the investors, it is directly addressed to the company. So that addressee should be there. Then the identification of the prospective financial information. So the identification is, suppose you have gone through the prospectus. So in prospectus, there are a lot of things. And one of the part is this prospective financial information. So when you are giving a report, examination report, you write it down that on this page of the prospectus, we have given our examination report related to the prospective financial information. So that is identification of prospective financial information. Then we need to give the reference to the standard of auditing applicable to the examination. So what is the standard? We are going through it. That is SAE 3400 is applicable to the same. A statement should be that the management is responsible for the prospective financial information, including the underlying assumption. So management responsibility statement should be there. Then a reference should be there for the purpose and the restriction or distribution of the prospective financial information. So it is very important that if you are giving a examination report for some specific purpose, and if it is utilized by the management for general distribution to their investors, then it will be wrong. So clearly mention in your examination report that this report, examination report, is for this specific purpose only, and it should not be used by the others. Then the statement that the examination procedure included examination on a taste basis. So clearly write that the examination was done on taste basis. We have seen all the material assumption, we have tasted it, and it is not that we have gone through all the assumptions or all the hypothetical assumption or based estimate. It has been done on the taste basis. And the supporting evidence of the assumption, amount, and other disclosure in the forecast and projections. So all these things need to be written in our final examination report. Now we have to give a negative assurance as to whether the assumption provide a reasonable basis for the prospective financial information. So what is a negative assurance? So we will write that based on our examination of the evidence supporting the assumption, nothing has come to our attention which causes us to believe that this assumption not provide the reasonable basis for the projection. So that is a negative assurance, that nothing has come to our attention by which we can say that the assumptions are not valid. So we have to provide a negative assurance. Then the opinion paragraph, we have to opine as to whether the prospective financial information is properly prepared on the basis of the assumption and is presented in accordance with the relevant financial reporting framework. So what is the relevant financial reporting framework? That is our accounting standards, auditing standards, and the act under which it is prepared. So we have to opine that yes, proper accounting policies has been followed, proper assumptions are followed, and it is presented as per the relevant financial reporting framework. This is the opinion which we need to give. After giving the opinion, we need to provide the appropriate caveats concerning the achievability of the result indicated by the prospective financial information. So as an auditor, we should write that that in our opinion, the projection is properly prepared on the basis of assumptions set out in note. So assumptions will be given by way of a note. So we have to give a reference to the assumptions undertaken by us while giving this examination report. Those assumptions are consistent based on the historical financial statement using appropriate accounting policy. And now the caveat should be that even if the event anticipated under the hypothetical assumption do not occur, or occur, the actual results are likely to be different from the projections. Since the other anticipated events frequently do not occur as expected and the variation may be material. So we are giving a caveat that even though the assumptions which are considered, hypothetical assumptions which are considered, they might occur, but the results which were anticipated by the company might do not occur. So what is an example for that? Management says that our sales will increase by 50% and therefore our profitability will increase by say so much of the percent because we will be able to recover our fixed cost. Now it might happen that the assumption that 50% of the sales has increased, but the profitability has not increased due to other reasons. So that is a caveat that though the assumptions which were taken by the management that has occurred, however, the final result has not come because of these factors. And ultimately, we have to give the date of our report, the place of signature where we are signing, and as discussed earlier, why the date of report is important because it should be a date when all the procedures are completed. And after that, any change in assumptions are not considered by the auditor. So date is of very much important. And at the end, the signature. Now, the report on examination of prospective financial information. It may be a clean report, adverse report, or it may be we simply say we withdraw from the engagement. So while presentation and disclosure of the prospective financial information is not adequate, so in such case, the auditor need to give a qualified or adverse opinion that the assumptions which were given or the disclosures which are made based on the assumption are not appropriate and therefore the auditor is giving a qualified opinion. And if the auditor is not in a position, then the auditor might think to withdraw from the engagement if it thinks appropriate. Now, there will be a situation when one or more significant assumptions do not provide a reasonable basis for the prospective financial information and is prepared on the basis of best estimate assumption or hypothetical assumption. So you do not agree to the assumptions which are given by the management. In that case, you need to express an adverse opinion, setting out the reasons in the report on the prospective financial information. So what can be the reason? The reason can be that the assumptions which are given by the management are unrealistic. They are saying that our profitability will increase by 10%, although historically they have profitability of only 2%. They do not have any capex plan. They have not given any assumption related to capex plan. Then also they are saying that our profitability will increase by say 10% and it will increase from 2% to 10%. In such cases where we do not agree to the assumptions, we need to give an adverse opinion or might think to withdraw from the engagement. Now, there might be situation which preclude the auditor uh, or the auditor opinion examination is affected by the conditions that preclude application of one or more procedure considered necessary in these circumstances. So it might happen that you are consistently following up with the management that give us the assumptions, give us the working, what are the external factors, give us the understanding of your business, but management is not supportive and they preclude you from the application of this examination procedure. So in such a case, the auditor should either withdraw from the engagement or if he is compulsory required to give an opinion, then he should put a disclaimer and describe the scope limitation that following assumptions were not supported or not no proper supporting has been made available to us. So put a disclaimer in your final examination report. So to sum up, while finalizing the examination report, it can be a clean report if all the assumptions are given properly. We agree to that assumption. If the assumptions are not clearly given, that it might be a qualified opinion or an adverse opinion. If suppose the assumptions are made on say hypothetical basis, then the auditor should also go for the adverse opinion in that case. And if the auditor is precluded from applying the examination procedure which are necessary to give an examination report. In that case, the auditor should either withdraw from the engagement or should put a disclaimer in his final opinion, and also describe the scope limitation in the report of the prospective financial information. So with this, I have covered SA 3400, SAE 3400. I hope any questions we will be taking at the end. I hope it is clear that when we need to follow the SAE, it is mainly while we are giving or certifying any prospective financial information. It can be either in a way of a project report. It can be in a way of a prospective financial information which is given in a prospectus. It can be a information which is given to some investor that yes, we will be achieving this target. If as an auditor you are required to certify the same, you need to follow the procedure which are required under SAE 3400. Excuse me. Now SAE 3420, that is the assurance engagement to report on compilation of pro forma financial information included in a prospectus. So it is very clear when we need to follow this SAE 3420. It is required to be followed when we need to certify or we need to give a report on the compilation of pro forma financial information which are included in a prospectus. Now the scope of this SAE. This SAE deals with the reasonable assurance engagement. So see a difference. In 3400, we were giving the moderate level of assurance. Here, we need to give a reasonable assurance engagement, which is undertaken by the practitioner to report on the responsible party compilation of pro forma financial information included in prospectus. This SAE applies where such reporting is required by SEBI in the jurisdiction in which the prospectus is to be issued, or this reporting is generally accepted practice in such jurisdiction. So let me tell you. Sometimes when we go for this public issue, IPO, so while in a process of filing IPO, the company might acquire some subsidiaries, or they might disinvest some of its allocation. So in that case, if they have taken some subsidiary or they have taken some subsidiaries, acquired some subsidiary, they need to prepare a pro forma financial information. So pro forma financial information is prepared in a way that as if in IPOs, we need to give figure of say 3 years, at least 3 years. So as if from the beginning of that third year, the subsidiary was integral part of that entity, we need to combine and consolidate that figures, and we need to issue a pro forma financial information related to the same. So this is the basic engagement for which the responsible party, that is the client, comes to the practitioner for the compilation purpose and for issuing a report whether the compilation of pro forma financial information to be included in prospectus is properly done or not by the management, and which is as per the required SEBI Act. So what are the responsibility? Here, practitioner responsibility means our responsibility of an auditor. So as a practitioner, we do not have any responsibility to compile the pro forma financial information for the entity. Such responsibility rests with the responsible party. So compilation is not our responsibility. We only have what is our responsibility? Our responsibility is to report on whether the pro forma financial information has been complied in all material respect by the responsible party on the basis of the applicable criteria. So see, it's very clear we don't have to take the responsibility of compilation of this pro forma financial information. What is our responsibility? To report that it has been properly complied by the management or by the responsible party, and that compilation has been made in all material respect on the basis of the applicable criteria. So the word applicable criteria is also of very much importance. Applicable criteria means on what basis the pro forma financial statements are prepared or information is prepared. Applicable criteria can be the accounting standards, it can be Ind AS, it can be IGAAP, it can be Companies Act. We will see it in detail in our next slide. So this SAE does not deal with the non-assurance engagement, in which the practitioner is engaged by the entity to compile its historical financial statement. So if as a practitioner, the management comes to you and they say to compile, then this SAE will not be applicable. It will be applicable only when you have to report whether the compilation has been done properly or not. Now, what is the purpose of pro forma financial information included in a prospectus? The purpose of pro forma financial information is solely to illustrate the impact of significant event or transaction on unadjusted financial information of the entity, as if the event has occurred or the transaction has been taken at an earlier date selected for the purpose of illustration. So let me give you an example. In the prospectus, if I am going for IPO in the prospectus, I am giving the figures of say 1/4/19, March 19, March 20, March 21, and March 22. Now, if suppose I have acquired or certain event has occurred place, I have acquired some subsidiary, then for the purpose of illustration, I need to prepare a pro forma financial information that as if this subsidiary was consolidated, then what will be the impact on my financial statement? So that is a pro forma financial statement. Unadjusted financial information are the historical financial statement of the entity. Once a pro forma adjustments are made to that, it will be known as a pro forma financial information. Thus, a pro forma financial information do not represent the entity's financial position, performance, or cash flow. So it's very clear, entity on standalone basis will be having a different picture. If it is considering the consolidation which has taken place or it has acquired a subsidiary at a later rate, but it needs to be reflected as if it has acquired the subsidiary right from the beginning of the period which is presented in the prospectus. So it does not present the entity's actual financial position, performance, or cash flow. Now, compilation of pro forma financial information. So while compiling the pro forma financial information, it should be identifying the source of the unadjusted financial information to be used in compiling, making pro forma adjustment to the unadjusted financial information, presenting the resulting pro forma financial information with the accompanying disclosure. So let me be clear, make you clear that it will be in a tabular format. In first column, it will be the unadjusted financial information. That is the historical financial information of the entity or a company. Then pro forma adjustments will be made. And after that, the resulting figure will be considered as a pro forma financial information. Let me give you another example. Suppose I have a subsidiary which is now acquired by me, and that subsidiary that company was earlier following IGAAP. Now, while going for the IPO, I need to convert the IGAAP financials to the Ind AS. So I will make the pro forma financial adjustments to those figures, unadjusted financial information figures of that subsidiary. So what is the kind of assurance we need to give? It is a reasonable assurance engagement. So reasonable assurance engagement is to report on the compilation of pro forma financial information and to obtain sufficient appropriate evidence about whether the related pro forma financial adjustment give appropriate effect to those criteria. And the resulting pro forma column reflects the proper application of those adjustments to the unadjusted financial information. So as an auditor or as an examiner or as a practitioner, we need to provide a report that the compilation of the financial information was done based on the appropriate evidence which have been obtained by us. The related adjustments which are given in the to the unadjusted figures are appropriate, and the resulting figures are properly reflected in the unadjusted financial information. It does not involve practitioner updating or reissuing any report or opinion on any historical financial information used in compiling the pro forma financial information, or performing an audit or review of the financial information used in compiling the pro forma financial. So let it be very clear that it is not a fresh audit report which you are issuing as an auditor to the historical financial information. You are only making the adjustment. It is, you are not doing the audit of the historical financial information. You are making the adjustments, pro forma adjustment to that information, and therefore it is not a performing of audit or review to the historical financial statement. Now, what are the objective of the practitioner? The objective of the practitioner is to obtain reasonable assurance about whether the pro forma financial information has been compiled in all material respect by the responsible party on the basis of applicable criteria. And if there are any finding by the practitioner, that finding should be reported in our examination report. So findings can be many things. Findings can be that for the depreciation, different policies are followed by the company. The accounting policy for booking of the interest income is differently followed by the company. For the impairment of intangible asset, the years have been taken differently by the company. That can be the findings by the practitioner, which should be mentioned in our final examination report. So important definitions. Firstly, pro forma adjustment. So pro forma adjustment in relation to unadjusted financial information include adjustment to unadjusted financial information that illustrate the impact of significant event or transaction as if the event has occurred or the transaction has been undertaken at the earlier date. So we have already discussed that the company is acquiring a subsidiary in the current year, but if it is presenting past 3 years figure in the prospectus, they need to consider that that subsidiary was its subsidiary since beginning of the financial figures which are mentioned in the prospectus. Then what are the adjustment to the unadjusted financial information that are necessary for the pro forma financial information to be compiled on the basis which are consistent with the applicable financial reporting framework and its accounting policy under that framework. So when you are compiling or when you are making the adjustment to the unadjusted financial information, it has to be within the applicable financial reporting framework. And the policy followed by both the companies should be under the same framework or should be the same. It cannot be that different accounting policies are followed while compiling the or while providing the pro forma adjustments. And the pro forma adjustment include the relevant financial information of a business that has been or is to be acquired, or a business that has been or is to be divested, to the extent that such information is used in compiling the pro forma financial information. So we have already discussed that when the pro forma financial statement or financial information are required to be prepared, when it is required under the prospectus, while filing the prospectus, the company has acquired or to acquire some another company, and what will be the possible impact of that acquisition or that divested has to be considered while preparing the pro forma financial adjustments. Now, what are pro forma financial information? So these are the financial information shown together with adjustment to illustrate the impact of an event or transaction on unadjusted financial information as if the event has occurred or the transaction has been undertaken at an earlier date. So already discussed, we have to provide consolidation for say all the years which are presented in the prospectus. Unadjusted financial information, that is the raw data, that is the historical financial statement of the responsible party, that is the company. And now applicable criteria. So applicable criteria are the criteria used by the responsible party when compiling the pro forma financial information. A criteria may be well established by an authorized or recognized standard setting organization or by law or regulation. And when there are no established criteria, then they will be developed by the responsible party. So in India, we have a set of accounting and auditing framework. They can be considered as applicable criteria under which the pro forma adjustment or the pro forma financial information needs to be prepared. Now, we have gone through what is to be done, how it is to be done. We will see in our slides. So before accepting the engagement or at the time of accepting such engagement, what factors need to be considered by the auditor? So while accepting the engagement, we need to determine that the practitioner has the capability and competence to perform the engagement. So it is in line with SQC1, that is Standard on Audit Quality Control, that whether as a practitioner, I will be able to justify my capabilities, whether I have that competence to perform the engagement, it should be determined by me. It should be determined that the applicable criteria are suitable and that it is unlikely that the pro forma financial information will be misleading. So as an auditor or as a practitioner, we should go through that the applicable criteria under which, that is the accounting standard which we need to follow for the financial framework, that are suitable to that entity. And if they are not suitable, then it should not be misleading. Then the practitioner has to determine the likely to express the opinion so prescribed by the relevant law and regulation. So whether based on the information which will be provided by the uh, responsible party, whether the practitioner would be able to provide the opinion or not. Then we have to see where the sources from which the unadjusted financial information and any acquiry or disinvested financial information have been extracted. So the information which are unadjusted financial information, what is the source of that? And whether they have been audited or reviewed, and when the modified audit opinion or review conclusion has been expressed or the report contains an emphasis of matter, it should be considered whether or not the relevant law or regulation permit the use of or reference in the practitioner report, the modified report or a review conclusion. So see, what does it say? You need to identify the source information from which it has been compiled. Now, the information which is made available to us, that is the financial or historical statement, they might have been audited. And if they are audited, it might happen that they have given a modified opinion or a qualified opinion. So as an auditor, whether it is permitted to straight away go with the modified opinion mm, or a qualified opinion, then if the law permits, then yes, you can write in your report that yes, these are the qualifications given by the earlier auditor. But if the law does not permit it, then you need to give the effect of that qualification while preparing the pro forma financial information. So the possible impact if certain provisions which are not made by the company earlier and the auditor of that company has given a qualified report. Then while comparing or providing an examination report on pro forma financial information, the as a practitioner, I should or I will need to quantify the impact of that provision which are not made. And I will need to make that provision in my pro forma adjustments which are to be done. And it might happen that if the historical financial information have never been audited or reviewed, as a practitioner, I have to see whether I can obtain a sufficient understanding of the entity and its accounting and financial reporting practice to perform the engagement. See, practically what happens that if we consolidate something for which the audit has not been done, suppose company has acquired any partnership firm and that partnership firm, no audit was carried on under the Companies Act. So whether while performing this procedure, I need to carry on the audit of that partnership firm under the Companies Act, then yes, because then only I will be able to provide a reasonable assurance that the figures which are there are perfect or are as per the applicable criteria. Then while accepting the engagement, we need to obtain the agreement of the responsible party that it acknowledges and understands its responsibility for adequately disclosing and describing the applicable criteria to the intended user if these are not publicly available. Compiling the pro forma financial information on the basis of the applicable criteria. So kindly write in your engagement letter what are the responsibility and make them acknowledge their responsibility and make them understand that they are responsible for the adequately disclosing and describing the applicable criteria and its intended users. So providing the practitioner with, in the engagement letter, we should write that we should be provided with or we should have access to all the information, including when needed for the purpose of engagement, information of the acquiree in a business combination, such as records, documentation, and other material relevant to evaluating whether the pro forma financial information has been compiled in all material respect on the basis of applicable criteria. So please write in your engagement letter that we should be provided as a practitioner with all the information, and it should be provided on timely basis. Whatever documentation we ask, whatever records we ask, whatever material we ask, whatever information we ask for the purpose of carrying out this examination procedure, it has to be made available to us by the responsible party. If any additional information is needed, it may be requested from the responsible party as per the terms of engagement. It should be that we should have access to those within the entity and the entity advisors from whom the practitioner determines it's necessary to obtain the evidence relating to evaluating whether the pro forma financial information has been compiled in all material respect. So not only that the management has to give the information, also write in the engagement letter that if any information, if it is required from the advisors whom the practitioner determines that it is necessary, those advisors are also bound to give this information to us. Many a time, while certifying the restatement or while certifying the pro forma financial information, we need to deal with the merchant bankers and all that, or we need to deal with the actuarials, any valuers. Then we should write in our engagement letter that yes, that advisors should also provide us the necessary information which are required for carrying out the examination of the pro forma financial information. We should also write that when needed for the purpose of engagement, we should have access to the appropriate individuals within the acquiry in a business combination. So if any business which is acquired by the company, subsidiary, other companies acquired by the company, clearly identify the individual from whom the information will be made available to us from that business combination. Now, once the acceptance of engagement letter has been done, now we need to plan and perform the engagement as an auditor. So what are the steps which the auditor need to follow while discharging its duty or while planning and performing the engagement? So first thing is that the practitioners will be assessing the suitability of applicable criteria. So the applicable criteria which are suitable to the entity, suppose the company needs to follow Ind AS, then it need to be prepared, pro forma financial information has to be prepared under Ind AS. So what are the applicable criteria needs to be assessed. Then second thing is materiality. So when planning and performing the engagement, the practitioner shall consider materiality with respect to evaluating whether the pro forma financial information has been compiled in all material respect on the basis of applicable criteria. So materiality has to be seen while compiling or while examining the pro forma financial information. And this is very important that the practitioner should be obtaining an understanding of how the responsible party has compiled the pro forma financial information and other engagement circumstances. So we should obtain the understanding that how they have compile the pro forma financial information, how they are doing the engagement, what are the steps they are following, what are the event or transaction in respect of which the pro forma financial information is being compiled, the nature of entity, any acquiry or any acquisition or any disinvestment made by the company. We need to understand their operations, their assets and liability, the way they are structured, how they are financed. All things need to be understood. In addition to that, it should be also helpful if we understand the relevant industry, legal and regulatory industry under which it falls, other external factors pertaining to the entity, and the acquiry or the disinvesting. So these are the factors which needs to be understood while before performing the examination of this engagement. Then we should obtain the evidence about the appropriateness of the source from which the unadjusted financial information has been extracted. So the financial information, unadjusted financial information, which are made available to us by the management. So from where it is made available, whether it is audited financials, which are already audited, so it has more authenticity. If they are unaudited, then we need to carry out the additional procedures to make it suitable for the purpose of compiling the pro forma financial information. So it needs to be checked from where the source information has been extracted by the management. Then we need to obtain evidence about the appropriateness of the pro forma adjustment. So pro forma adjustment which are made, whether they are appropriate or not. So pro forma adjustment can be made on different, there can be three factors. Some of the pro forma adjustment can be based on the directly attributable to the event or transaction. Some of the pro forma adjustments are based on the factual supported some documents which are made available to us. And other pro forma adjustment will be based on the applicable financial reporting framework. That is, we have already understood that the company is following another accounting policy, and while consolidating, we need to follow the same accounting policy within the entity. So now, while planning and performing the engagement, we need to see whether the modified audit opinion or review conclusion or emphasis of matter paragraph with respect to source from which the unadjusted financial information has been extracted, or the source from which the acquiry or divestiture financial information has been extracted, the practitioner shall consider the possible effect of the same on his report. So whenever we are issuing a final report on this pro forma financial information, we should go through the audit reports which are made available to us. It can be a modified audit opinion or a review conclusion, and it can be an emphasis of matter paragraph. Emphasis of matter is not a qualification. It is just a nod drawing attention in the financial statement that this particular item is required to be noted to the special notice to the shareholders. That is termed as emphasis of matter. So if there is some modified audit opinion, the practitioner should consider the effect of the same on his report. And the effect is, if the effect is material, it should be quantified and the adjustment should be given in the financial, in the pro forma financial adjustment. Now, when the source from which the unadjusted financial information has been extracted or a pro forma financial adjustment is not appropriate, then the same shall be disclosed with the responsible party, and how to resolve the matter of disagreement and what further action to be taken. So suppose the information which is given to us, suppose they say that this company was not audited earlier, but we have a trial balance and we are giving you the trial balance, and based on that you provide the pro forma, we have provided the pro forma adjustment. So in that case, as a practitioner, we should say that it is not an appropriate source. You get the financials or unadjusted financial information audited. It should be discussed with the responsible party and resolve the matter, and then only we will be taking the further then only we will be taking into further consideration while giving our final report. Now, while obtaining the evidence about the calculation within the pro forma financial information. So even the calculations which are given in the pro forma financial information needs to be checked. mathematical calculation can be there, ratios can be there. All ratios and other things need to be checked by the practitioner. And overall, we need to evaluate the presentation of the pro forma financial information, and we need to evaluate whether the pro forma financial information which are given is complete in all sense as per the applicable accounting framework. So planning and performing the engagement. So we have seen that while performing the engagement, there are certain adjustments which are needed to be given to the unadjusted pro forma figures. So what are these adjustments? The practitioners will determine whether the pro forma adjustments are, they can be of three types: directly attributable to the event or transaction, factually supported, and consistent with the entity's applicable financial reporting framework and its accounting policy. So these are the three, more or less three pro forma adjustments which are needed to be given to the unadjusted financial pro forma information. So to give an example, directly attributable to the event. So suppose when you are compiling or when you are examining the documents, you came to know that the company has acquired this business, but out of that there are two divisions which the company will sell out in the near future, say within 1 year. Then while certifying that pro forma financial adjustment, you should consider that yes, this things has been will be sold out, and what will be the possible impact of the same on the pro forma financial adjustments. Now factually supported adjustment can be based on the purchase and sales agreement entered by the company. If valuation reports are taken, then whether any adjustments are needed to be made to the historical figures based on the valuation undertaken by the company. That is our factually supported adjustments. Published financial statement, agreements, employee agreements, action with those charged with governance, board reports, any audit committee reports, relevant legal or regulatory action, such as the area of taxation. So these are the factually supported adjustments which are needed to be made by the management while compiling this, while compiling the financial pro forma adjustment. Now, the third thing is that the adjustments which are to be made that are consistent with the entity's applicable financial reporting framework and its accounting policy. So for the pro forma financial information to be meaningful, it is necessary that the pro forma adjustment should be consistent with the entity's applicable reporting framework and its accounting policy. So if the company is following a different accounting policy, we need to provide a pro forma adjustment to make it in line with the entity's accounting policy. So these are the examples, broad examples of what are the pro forma adjustments which are needed to be made to the unadjusted financial information. Once these adjustments are made to unadjusted financial information, it will be termed as a pro forma financial information. So other information. So if you, we have already seen that when we need to provide a pro forma financial information, it is needed to be provided in the prospectus. So in prospectus, there are a lot of other informations which are given. So as a practitioner, we should read the other information included in the prospectus containing the pro forma financial information to identify material inconsistency, if any. And if we identify any material inconsistency or become aware of that material inconsistency, the practitioners will discuss the matter with the responsible party. So what does it say? Again, in a pro forma financial statement information, we have taken that this subsidiary we have taken and we have made the adjustment of the last 3 years. But the company has written in the prospectus that this company has been taken over by the company for just 2 months, and after 2 months it will be sell off. So whether adjustment needs to be provided for the pro forma financial information? Then my answer is no. So both the information which is given under the prospectus and the compilation which is done by the responsible party are not matching. So in such case, we should see that whatever we are doing, that is in consistency with the other information which are contained in the prospectus. So coming to forming an opinion. So opinion can be unmodified opinion. Unmodified opinion pro forma financial information has been compiled in all material respect by the responsible party on the basis of applicable criteria. So if there is an unmodified, if the compilation has been done properly as per the applicable criteria by the responsible party, then the auditor or practitioner will issue a unmodified opinion. However, if the above things are not properly compiled as per the applicable criteria, then the practitioner need to discuss while issuing a modified report, modified opinion. The practitioner shall discuss the matter with the responsible party. And if the responsible party does not agree to make the necessary changes, the practitioner shall withdraw from the engagement, or they should consider to take a legal advice. So again, coming back to the report, how the report or opinion has to be drafted, it should be first having a title. A title should clearly indicate that the report is an independent assurance report. So firstly, it should be an independent assurance report because it is a reasonable assurance which the company, which the auditor need to give. So it is an independent assurance report. It should be addressed to someone has agreed in the term of engagement. So to whom the report is addressed has to be written over there. There should be an introductory paragraph that identify the pro forma financial information, the source from which the unadjusted financial information has been extracted, and whether or not an audit or review report of such source has been published. So in our opinion, in our examination report, we have to write the source from which the information has been extracted and whether the information which are extracted are audited or not. The period covered by or the date of the pro forma financial information, it has to be clearly mentioned. A reference to the applicable criteria. So reference to be made is to be made that whether it is covered under Ind AS, IGAP, a reference to applicable criteria, on the basis of which the responsible party has performed the compilation of the pro forma financial information. So it has to be mentioned in the report itself. A statement should be made that the responsible party is responsible for compiling the pro forma financial information on the basis of applicable criteria. So a statement should be there for the clearly stating what are the responsibilities of the responsible party, that is management. A description should be there of the practitioner responsibility. What will be our responsibility as a practitioner should be included, and it should include a statement that the practitioner is to express the practitioner responsibility is to express an opinion whether the pro forma financial information has been compiled in all material respect by the responsible party on the basis of applicable criteria. So our responsibility is only to opine whether the pro forma financial information has been properly compiled in all material respect by the responsible party on the basis of applicable criteria. That is the basic view or basic opinion which we need to give. We should do that for the purpose of this engagement, the practitioner is not responsible for updating or reissuing any report or opinion on any historical financial information used in compiling the pro forma financial information. So we should clearly mention, suppose the financial information, unadjusted financial information, which is made available to us, but in that financial information, the company has not followed certain accounting standards. And now when we are compiling the same or when we are giving a report, we are making the debt financial statement as compliant with the available accounting framework. So we should clearly mention that it is not a reissuing of audit report to any historical financial information. It is just an examination report which we are giving for the purpose of compiling the same in the prospectus. Then the purpose of the pro forma financial information to be included in prospectus is solely to illustrate the impact of the significant event or the transaction on the unadjusted financial information. So it should be clearly mentioned that what is the purpose of this pro forma financial information? It is only for the basis of including the same in the prospectus. It is not that we are reissuing or we are modifying the report which was earlier given. Further, a statement that the engagement was performed in accordance with SAE 3420. So we should write under which SAE this engagement was performed, and we should write our scope that this SAE requires that the practitioner company should comply with the ethical requirement and plan and perform the procedure to obtain reasonable assurance about whether the responsible party has compiled in all material respect the pro forma financial information. So clear statement should be there that our scope is as defined under SAE 3420, and that requires us to comply with the ethical requirement and to plan and perform the procedure to obtain the reasonable level of assurance. Now, the procedures which are selected shall depend on the practitioner judgment, having regard to the practitioner understanding of the nature of the entity, the event or the transaction in which the pro forma financial information has been compiled, and the other relevant engagement circumstances. So it is very clear that while planning the extent and nature of examination procedure, it will be dependent on the practitioner judgment also, and the practitioner should be having the understanding of the nature of the entity and the event or transaction which has taken place. Now, unless otherwise required by law or regulation, the practitioner opinion uh, using one of the following phases, which are regarded as being equivalent. So the pro forma we should write in our opinion that the pro forma financial information has been compiled in all material respect on the basis of the applicable criteria, and the pro forma financial information has been properly complied on the basis stated. And then a signature and date should be mentioned. So I think I have covered both the essay, and this is the end of slide. I will be happy to answer the queries, if any.
Thank you so much, sir. Thank you so much, sir.
Yes, sir. Yes.
So there are certain questions, sir. These two standards are compulsory for private limited company also.
Yes, yes. But see, when it is all the standards are applicable to all the entities, maybe it a partnership firm, then also while doing or discharging our audit duties or the engagement function, we need to follow the auditing standard. So not only
Okay,
the
sir.
corporate, it is also to be discharged while preparing a project report of, say, a partnership firm also.
So what, except perspective financials, what all other engagements are covered? Can you put some light or some examples, please?
Yes, yes. See, in this SAE 3400, the term prospective financial information is very wide. It can be used by the management for many purpose, varied purpose. Suppose one example is I have given that if the bankers ask that you get your project report certified from the auditors or from the some chartered accountant, that will be a prospective financial information. And while certifying that, we need to follow this SA 3400. That is one example. Second example can be when we certify the information in the prospectus. In the prospectus, also the merchant bankers ask us to certify the prospective financial information. So while discharging our duties at that time, we need to follow SA 3400. And the major thing is that we need to write all the assumptions which are taken. If we do not write those assumptions or notes, then and fairly speaking, we do not write it. When we issue or certify a project report, generally we do not write the assumptions or notes in detail. So please follow SA 3400, give a report. Sometimes I have seen that even we do not issue a report. We just do a stamping on the project report and we give to the bankers. So it is not a correct method. We need to give a report as per SAE 3400. One another thing can be that for the purpose of valuation, we give the prospective financial information, and that valuer asks the company that you get it certified from the some chartered accountant. So at that time we need to follow SA 3400.
So nowadays banks are asking for chartered accountant signature on financial statements. Like client has filed ITR under section 44 AD of the Income Tax Act. So how to deal with such situation?
So it is you should give it in a report format. If they are saying that you certify ITR, then you should be following. It is a certificate which you are giving that yes, the ITR which was filed by the company on the website is same which is submitted to the banker. So it is a certificate which you are giving. So you need to give a report as per the SQC1 certification which we need to give.
Sir, can auditors certify provisional accounts like for bank loan purpose before completion of audit?
See, there is no term as provisional. Auditor cannot certify the provisional financial statement. Provisional, that is a term which has been dictated by us or by the bankers. When the bankers ask you to certify the provisional financial statement, you should say that you should not write the word provisional. You should say that we have carried out a limited review of the same, and please give the review report. You do not write the word provisional. You give a report, review report, that we have reviewed the financial and the other information.
Yes, sir. Sir, word certified was used several times. I hope we have to report on the financial information. Kindly clarify whether we have to give certificate under section SA 3400 and 3420.
Yes, it is an examination report, but again, examination. Both the standard says that SAE says that while discharging duties under this standard, this SAE, you also need to follow the other auditing standard. So it is an examination report, but examination is on we need to give a assurance. So when we are giving a assurance, it is a certification which is needed to be given. But the report
Yes,
has to be report is clearly given under this SAE. So we need to follow the report format which is given under the SAE 3420 and 3400.
Sir, whether the compliance of standard on assurance engagement is equally applicable to the unorganized sector entities who are also financial seekers for their ventures in large numbers?
See, I say that
Yes.
as are applicable to the auditors. So whether we audit a non-corporate entity or a corporate entity, it is the onus of the auditors to discharge their to discharge their engagement to follow the auditing standard. So it has to be followed while discharging any assurance or engagement engagements.
So the information, estimates, and material assumptions collected are then based on satisfaction of the appropriate evidence and other factors at the time of consideration to form the judgment to issue a certificate. Such judgments are based on particular time. These days, changes are very dynamic. Let's take example of Baiju's, Chinese company, Vivo Mobiles. How far the chartered accountants can be held guilty of professional misconduct, whether they are exercise full care of in issue of such certificates. After all, there is no forensic or fraud audit or certificates.
This is very good question, because when something goes wrong, even in Baiju's and all that, the first thing comes to the information which has been certified by the auditor or by the practitioner. So let me give you that if you have written all the assumption and if you have followed this SA 3400, it might help you to come out of that. If you are giving a report without mentioning, see, if you can justify in the court of law or to the institute that yes, I have followed this 3400, I have given all the assumptions which were given by the company, I have tested the assumption on test basis, I have clearly demarcated that these are based judgment assumption, these are hypothetical assumption, all things has been followed, all documentation has been done, this will help you. See, otherwise, we all know that even though we are auditing, we take the lot of documents, but when it comes to discharge or when it comes to explaining the regulatory authorities, it is difficult. It is difficult. So please follow this, take the maximum documentation, because see, it is not that if you're not following the standard, then you will be guilty of misconduct also under the Chartered Accountants Act.
Yes.
And
Sir,
please clearly
expression
write in your
of opinion.
just to it, please clearly write in your report that we do not vouch for the accuracy of forecast. We have tested the assumptions which are given to us by the company, and that clearly should be mentioning in our examination.
Sir, expression of opinion on projected financials of non-corporate entities. Does the assurance engagement standards apply on such cases also?
Yes. It applies because you are discharging, you are the auditor. See, generally what we do, we always we know the Income Tax Act, Companies Act, GST Act, which are needed to be followed by the companies or by the entities. These are the standards which are needed to be followed by us. But generally we ignore the standard, because
Yes.
if you see the reports of NFRA which are coming, they clearly states that the auditor have not followed this standard, this para of this standard. So while documenting now, please go through, you document standard wise, auditing standard wise, you document that yes, we have taken, starting from this engagement letter you have taken, MRL you have taken, how you have understand the need of the entity, what is the nature of the entity. So document all the things. Audit plan is of very much important now.
So for the financial provisional financial statements, if the period is already passed, let's say if financial statements for 31st December need to be certified in January 2023, how to deal with it?
Again, I could not get the question.
Provisional financial statements, if the period is already passed away, let's say financial statements of 31st December need to be certified in January 2023. So how to deal with it?
See, again, I would say that any period which has gone, that is 31st December, that is a gone period. You cannot use the term provisional. You give a limited review report that we have reviewed the financials and given a limited assurance. We are not giving a full assurance, and bankers are accepting the same. Don't write the word provisional. Provisional is nowhere there in the standards and other things.
So last question, do we need to follow the certificate formats even for the predefined certification formats under Income Tax Act such as 15 CB?
Yes. See what happens. Generally, when you are certifying for some tender purpose, they also give us the formats. So what practically we should do, we should certify that format because it is required, but give a report also, certified report also, which should be forming part of that. And that format should be considered as an annexure to our main report. So even just to add, in income tax, when we are certifying MAT report 15 CACB, you need to follow the SQC1 certification.
Okay, sir. Thank you so much, sir. Now we come to an end. It was wonderful deliberation, and you have covered all the aspects of both these standards as well as clarified all the doubts of the members. We have gained a lot. Hope our members have also gained a lot through your deliberation. On behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time, sir, and enlightening all of us on various both the SAEs. Thank you so much, sir. Thank you so much.
Thank you.
Namaste.
And thank you all the listeners for the patience hearing and good questions.
Thank you,
I think interactive session has been made by these questions.
Yes, sir. Yes, sir. Thank you, sir.
Thank you.
Thank you.